Welcome to StockTok's deep dive into 3 Million Co. 3 Million is one of the most recognizable industrial conglomerates in the world, producing everything from abrasives and adhesives to personal safety equipment and electronic materials. At the time of recording, the stock is trading at 154.55, sitting within a 52-week range of 124.65 on the low end to 177.41 on the high end. The RSI, or Relative Strength Index, a momentum gauge where readings above 70 signal overbought conditions, sits at a neutral 58.9. The 50-day moving average is 155.53, marginally above the current price, while the 200-day moving average is 157.41, suggesting the stock is in a mild near-term consolidation. Let us work through the fundamentals, scene by scene, starting with a quick business overview. 3 Million Co. is a diversified industrial manufacturer with operations spanning safety and industrial products, transportation and electronics, and healthcare solutions. The company's competitive moat rests primarily on its deep patent portfolio, brand recognition, and global distribution infrastructure built over more than a century. The StockTok score for 3 Million Co. comes in at 40 out of 100, which falls into our caution tier. Breaking that down across 5 dimensions: valuation scores 10 out of 20, financial health 13 out of 20, profitability 9 out of 20, growth 0 out of 20, and smart money 8 out of 20. That growth score of 0 is a number that demands serious attention. Now, valuation. The question every investor has to answer: are you paying the right price? At the time of recording, 3 Million Co. trades at a trailing price-to-earnings multiple of 25.76 times. That means investors are paying roughly $26 for every $1 of reported earnings. The forward price-to-earnings ratio, which uses consensus earnings estimates for the next 12 months rather than historical results, drops to 17.9 times, implying the street expects a meaningful earnings recovery ahead. The EV to EBITDA multiple, which compares the company's total enterprise value to its earnings before interest, taxes, depreciation, and amortization, and is a cleaner debt-adjusted valuation lens, stands at 13.52 times. In our view, the economic moat here is real but moderating. 3 Million Co. benefits from intangible assets in the form of its patent library and brand, along with meaningful switching costs in its industrial and healthcare segments. However, the data suggests pricing power has been under pressure as the company navigates legacy legal liabilities. Guru Focus Value, an independent intrinsic value estimate, sits at 131.95 at the time of recording, while the stock trades at 154.55. That implies a negative margin of safety of 17.13%, meaning the stock appears to be trading at a premium to that independent fair value estimate. Wall Street analysts at the time of recording have a consensus mean target of 175, drawn from 17 analysts, with a high target of 230 and a low of 120. The next earnings report is due in April of 2026, with the street expecting earnings per share of approximately 1.98, with estimates ranging from 1.77 on the low end to 2.03 on the high end, a near-term catalyst worth monitoring closely. Market sentiment around 3 Million Co., as of the creation of this video, leans neutral, with insufficient recent news flow to tilt the signal in either direction. On balance, in our view, the valuation here is modestly stretched relative to the company's growth profile. Moving to financial strength, how solid is the foundation? The Piotrowski F-score, a 9-point checklist that evaluates profitability signals, leverage trends, and operating efficiency, comes in at 5 out of 9 for 3 Million Co. A score of 5 sits in the middle range, not a distress signal, but not a pristine balance sheet either. The Altman Z-score, a model originally designed to assess corporate bankruptcy probability where scores above 3 are considered safe, registers at 4.22. That is comfortably in the safe zone, which warrants some reassurance. However, the credit picture carries complications. The cash-to-debt ratio is 0.47, meaning the company holds less than 50 cents in cash for every dollar of total debt, a relatively thin liquidity buffer. Interest coverage, which measures how many times operating earnings can cover interest expense, is 5.06 times. That is adequate but not ample, and we would want to see that ratio trend higher over time. The current ratio, which compares current assets to current liabilities as a short-term liquidity measure, stands at 1.71, which is healthy. The area that warrants caution, in our opinion, is the debt-to-equity ratio of 2.68. That means the company carries roughly $2.68 of debt for every dollar of shareholder equity, a leverage level that leaves limited balance sheet flexibility, particularly given the company's ongoing legal liability obligations. The verdict on financial strength: adequate for now, but levered. Next up, profitability. Is this business actually making money efficiently? We lead with return on invested capital, or return on invested capital, which measures how effectively a company deploys every dollar of capital across its entire business, regardless of whether that capital came from debt or equity. At 12.24%, the company is generating returns above the typical cost of capital for an industrial business, which we would generally anchor around 8 to 10%. That is a positive signal. Now, walking down the margin stack, gross margin, the percentage of revenue remaining after direct production costs, sits at 39.91%. For an industrial conglomerate, that is a respectable gross margin, reflecting the value-added nature of many of 3 Million's product lines. Operating margin, which layers in overhead and operating expenses, is 19.20%, a strong operating conversion rate that speaks to the efficiency of the business model. Net margin, the bottom line after interest and taxes, comes in at 13.03%. That is solid. However, the metric that gives us pause in our view is the free cash flow margin of 5.60%. Free cash flow margin measures how much of every revenue dollar ultimately converts to unencumbered cash after capital expenditures. A gap of roughly 14 points between net margin and free cash flow margin suggests meaningful cash leakage, likely tied to capital spending and working capital demands. The return on equity of 74.11% appears extraordinary, but it is heavily inflated by the high debt load we discussed, so we would not lean on that number in isolation. Onto growth: is this business expanding, and at what rate? This is where the StockTok score flags its most serious concern, and the data makes the case plainly. Over the trailing 3 years, revenue growth for 3 Million Co. is negative 1.6%. Over the trailing 5 years, it is negative 5.2%. These are not rounding errors. These are sustained, multi-year revenue contractions in a company that was once considered a hallmark of durable industrial compounding. The book value growth over the trailing 3 years is a deeply negative 30.8%. Book value per share, which represents the net worth attributable to shareholders on a per-share basis, has declined dramatically, primarily reflecting the weight of legal settlements and liability accruals that have consumed equity over time. The combination of shrinking revenue and collapsing book value is precisely why the growth dimension receives a score of 0 out of 20. Now, the one offset worth noting is the dividend yield of 1.92% at the time of recording. For income-oriented investors, 3 Million Co. has historically been a dividend aristocrat, a company with a long track record of consecutive annual dividend increases. However, it is worth monitoring whether the current free cash flow profile is sufficient to sustain and grow that dividend under the present capital structure. In our view, the growth picture is the central risk factor for this name, and any long-term thesis has to grapple honestly with whether the revenue trajectory can be reversed. Now let us talk smart money. What institutional capital is actually doing with this name? At the time of recording, 12 top-tier guru investors, meaning fund managers and super investors whose 13F filings are tracked for portfolio intelligence, hold positions in 3 Million Co. Among the named holders, Jensen Investment Management carries a position representing 0.07% of their portfolio, though they recently reduced their stake by 0.05%. Torrey Funds holds a position at 0.05% of their portfolio with no change in the most recent filing period. These are not conviction positions. They are small, and one is being trimmed. Zooming out to the broader 13F universe, the filings that institutions managing over $100 million in assets are required to submit to regulators. Only 10.7% of those filers are net buyers of 3 million co. For context, we would look for readings above 50% to characterize a name as broadly net bullish among institutional filers. 10.7% is a materially weak reading, and the data suggests institutional capital is largely stepping aside. Insider ownership stands at just 0.44%. That means the management team that runs this business owns a negligible fraction of the equity, which, in our view, is a misalignment signal worth noting. And in the most recent 3-month window, insider transactions recorded 0 purchases and 5 sales. 5 sells and 0 buys from people with the most intimate knowledge of the business is not a ringing endorsement. The smart money picture here, taken in aggregate, warrants caution in our opinion. And finally, the verdict. Let us bring it all together. On valuation, the stock is trading at a premium to its independent guru-focused fair value estimate, with the forward multiple suggesting earnings recovery expectations that still need to be earned. In our view, the valuation is modestly stretched for the growth profile on offer. On financial strength, the balance sheet is stable but levered, with a debt-to-equity ratio of 2.68 that leaves limited room for error and warrants ongoing monitoring. On profitability, the operating margins are genuinely strong, and return on invested capital sits above the cost of capital, which is the baseline we want to see, but the gap between net margin and free cash flow margin is a concern we would want to see close. On growth, this is the bear case in plain sight. Multi-year revenue contraction, and a deeply negative book value trajectory driven by legacy legal liabilities. Any long-term thesis here must include a credible path to top-line recovery. On smart money, the institutional picture is broadly cautious. Low 13F buy rates, negligible insider ownership, and recent insider selling all reinforce a posture of watchful patience, rather than conviction accumulation. The overall setup, based on what we see, is one that warrants caution. The StockTok score of 40 out of 100 reflects a business with genuine operational quality being weighed down by structural growth headwinds and balance sheet constraints. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That is the deep dive on 3 million co. Like and subscribe so we can keep providing you with no-nonsense data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.